We told them lower interest rates would be the confetti at the recovery parade, but the music never started. In 2025, we're not just watching the housing market, we're watching a confidence crisis in slow motion. And when optimism is silent, the wise ask better questions. ASB's chief economist Nick Tuffley returns to decode why the market is quiet and when should it be roaring.
Financial freedom faster. Financial freedom faster.
If you like watching other people make money, keep scrolling. But if you're the kind of person who wants the edge, the insight before the headlines, hit subscribe. Because in 2025, more New Zealand investors get their housing intel from this show than anywhere else on YouTube. The smart ones already know, and now you do too. Nick, why aren't recent OCR cuts translating into a housing market rebound despite cheaper mortgages?
Look, it's been quite a vexing question because when we've been looking at the housing market this year, we have been surprised that it hasn't really recovered that much. Look, it's still looking quite flat when you're looking at sales levels compared to last year. Prices are going up, but you do need a bit of a microscope to see the gains at the moment. So there are some encouraging signs there. But look, it is slow. I think we've got a couple of things happening. Either it could be that people are feeling very cautious still. You know, we do have the lingering concerns over, say, job security, particularly if you're in Wellington. We do have the global environment, which is looking a little bit uncertain as well. And we may also have people holding off, hoping that rates will get a little bit lower. So that's one possibility. Another thing is that, question mark, are interest rates at the levels that we have seen them drop to, are they still, in people's view, stimulatory or a good deal? And is that sort of putting people off a little bit now? Look, we are of the view that we'll see the housing market, gradually pick up a bit of steam going ahead. I think particularly once we see greater signs of wider recovery and the employment market recovering as well.
Are investors too focused on interest rates and ignoring these broader economic signals?
Well, actually, when we can see in the Reserve Bank lending data that they collect off the banks, the area where you are seeing, the main growth in mortgage lending is actually investors. So they do seem to be getting in on the bandwagon, even if it doesn't look like it's a lot. There's certainly more activity coming through in those areas, and a little bit on the first homeowners. And look, I do think when we step back, look at the market, you are in an environment where, house prices, they've leveled off, so getting a better bargain than what you are now is probably more difficult. Interest rates probably around as low as they will go as well. So from the affordability, probably as good as it will get on that front. And of course, your purchase price down a lot as well. And look, rental income generally is higher than what it was a few years ago. So the conditions are there for it to be, one of the better times we're likely to see for buying, at least over the last couple of years.
Well, it is a buyer's market, like you said. Yields are up and listings are up. Opportunities there. What do you think's keeping buyers on the sidelines? Is it macro threats from around the world, or is it more of a domestic focus?
Maybe more of a domestic focus, that sort of watch and wait. The thing for buyers is also that they don't need to hurry at the moment. There is a lot of stock still on the market. It's holding up. It's not really coming down. So there's not that rush to go out and buy everything in that sort of urgent way that you get when the housing market is in a boom and you get people just going, look, if we don't buy now, we're going to miss out. There is time on their side, and that may be contributing to it as well. The thing is, time won't always be on people's sides, but right now, that opportunity for people to just be quite picky is certainly there.
And what's your read on the consumer confidence and how it's influencing the market at the moment?
Well, consumer confidence, when you step back and look over the last year, it has been edging up, but it's doing it in fits and starts at the moment. And I think that's a reflection of people just picking up on the global turmoil at the moment. Look, the number of people have been talking about Donald Trump over the last sort of 2-3 months has really, really escalated. And so you do have a lot more of that uncertainty hanging around as well. And look at the signals from the government as well. It's come out and said, look, we don't have much money to do much. As well. It didn't really deliver much in the budget in terms of sort of everyday relief for households, even if it has sort of worked hard at coming up with a policy to try and encourage businesses to start spending a bit more money to improve their outlook. So it's still a sort of fairly quiet environment. And look, add to that right at the moment, petrol prices potentially bouncing around a little bit because you've had oil prices jumping around. Although I have to say, the level that petrol prices are at the moment is still sort of very low when you look at where they've been sitting at off and on over the last 5 years.
Yeah, well, I certainly don't mind if petrol prices go up. There might be a few less cars on the road. Is it farmers that are just holding the economy together? I saw your commodities report, dairy, meat, fruit, forestry. Is without that, we'd be in a lot of trouble.
Well, definitely we've seen our export sectors doing really well since late last year and the early parts of this year. So when you're looking at GDP, which is a measure of activity or the value add we're creating, it is being disproportionately skewed towards what's happening in that sort of agriculture, rural, broader export space. So that's a sort of key part of what's happening now. The recent GDP figures did suggest there's some life coming out in household spending overall, even though at a sort of retail level, we're seeing that the spending growth has been relatively modest. And look, one bright spark, particularly that relates to the property market, is we did actually see the volume of housing construction pick up slightly in the early parts of this year. So that sort of prolonged downturn in construction activity could be coming to an end as well. And look, if that trend continues, that's really encouraging.
OCR projections. There's been a lot of economists predicting that the OCR will keep going down. That tune seems to be changing now.
Look, I think the threshold for further cuts has got higher. Look, on balance, we still think the Reserve Bank will cut, probably at least one more time. The risk you have at the moment is you've got sort of two things the Reserve Bank needs to balance out. In the short term, inflation does look like it's going to end up somewhere around about 3%, give or take, and it really depends on where oil prices are from day to day. And the Reserve Bank is going to be quite cautious about that. Things that are driving up inflation in the short term, food and fuel. What do you buy quite frequently? Those two items. So you tend to notice price increases in those, and it tends to taint your perception of future inflation. A lot more than, say, when you buy a TV and you get much more bang for your buck than you did last time you replaced it. So there's that risk that they'll be worried about behaviour changes on that front. Longer term, medium term impacts on inflation from the tariffs, look like overall that will be negative. But at the moment, there's perhaps a sense that perhaps that impact won't be too bad, at least from a New Zealand point of view. So far, our exports are looking pretty resilient. At least we've entered this year in a really good position from that regard.
Yeah, well, balancing the positives and negatives of higher inflation is a delicate balance, I guess. I saw Labour poking holes in the price of butter, for example, and without realizing that a higher price of butter means our dairy exporters are doing well. How do we find that middle ground that works for us?
Well, look, the thing we do need to remember is that 95% of all the dairy product we create here in New Zealand gets exported, and those high global prices mean our farmers do well, and they provide the bulk of the export income that we use to, in a sense, pay for our imports. So it is really important. But yes, you do have those flow-on effects that butter and cheese are relatively expensive. It is the flip side of those export industries doing well. Same with sort of red meat, particularly beef at the moment. So overall, yes, we do better when those key export prices are high. But yes, reality is it does mean some food costs do go up. I guess that's the price we pay for being a country that exports great volumes of food. But flip it on its head, if we didn't produce any dairy and we were importing it, what price would we be paying? Guess what? Pretty much what Fonterra is able to get by selling its product on global market.
Yeah, that's often missed in the CPI reports and data. What's going on with tourism at the moment? We've seen a slowdown?
Look, it's been the general recovery has been slowing down. We're seeing a little bit of bouncing around with the earnings that we're getting out of China. It was a bit of a surge late last year that's tapered off. But in the early parts of this year, at least as measured anyway, the earnings we've got out of American tourists has actually lifted a little bit after being sort of quite quiet. So, hey, that's not a bad sign. Of course, maybe it's a few Americans coming over here to just check out the digs as they move after the election last year. Who knows? But the thing is, from here, the forward path for tourism, it's not going to be recovering in the same way that it has been in recent years. A lot of the key markets have already lifted up quite sharply. It's the Asian markets where there's scope for a bit more recovery. But we are balancing, say, two influences there. In this global environment, will people be more cautious about traveling? And so will there be just less tourists in the world? And we, lose out from that? Or will there be some offset from the fact that Americans probably don't want to go to China? They may feel a bit unwelcome in Canada and Europe, so they come here. And do Europeans go, no, we're not going to the US. We'll go to New Zealand instead, even though it's a long way away. So we could see a little bit of redirection of tourism that helps make up for any weakness. But we're about 85+% in terms of the number of visitors coming to New Zealand compared to COVID. The dollar value that they're spending here has recovered, but of course that dollar value is also including the fact that it's got more expensive for tourists when they're here as well.
Nick Tuffley, appreciate your insights today and look forward to chatting again soon.
Cheers, thanks for having me on.
Just a reminder, spectators don't win, they wait. They scroll and then they lose. Winners, they move, they buy, they bank. They're here. This isn't just the fastest growing property channel in the country, it's the last one you'll need. Subscribe or watch from the sidelines and try to smile while someone else buys your future.